The Roaring Twenties, a time of mirth and glamour in the United States, the age of flappers, gangsters, the Prohibition, and the age of prosperity. False prosperity. It's October 29th, 1929, the infamous Black Tuesday. The stock market has just crashed, and some people have lost everything. The infrastructure that was so precariously built upon the back of false prosperity, built on the back of money that didn't actually exist. Flash forward to 1933, thousands of people are out of work, thousands are starving, and still thousands more have already starved or have taken their own life. What brought about this travesty? What entity could have caused the biggest economic travesty that the United States have ever seen? That entity was based in New York. That entity was Wall Street.
The direct manipulation on Wall Street and the stock market greatly affected the stock market crash in 1929. Much of this was attributed to the false prosperity of the 1920s. Many of the upper middle class and high class people began to invest in the stock market with loans that were received from a stockbroker. The false prosperity made the stock market rise higher than ever and have an artificial growth due to many of the brokerage loans that were being handed out right and left to anyone. Someone could put down $1 and they would receive $9 more for the brokerage loan. This artificial manipulation of the stock market helped fuel the crash. Many of the more intelligent economists and Wall Street people began to realize that the prosperity and growth of the stock market was not going to last due to all the loans and money that was put into the stock market. Black Tuesday on October 29th, 1929, people began to sell out thousands of stocks, knowing that the stock market was going to crash. This was the first day of the stock market crash, losing over $8 billion. The overall manipulation of the stock market with the influence of the 1920s and the bad decision-making with loans caused the stock market crash that lasted for 4 years, along with the manipulation of the wealthier and more seasoned Wall Street operators' selling of stocks.
Another problem with the entire system was the fiscal irresponsibility of the common folk. Wall Street contributed to the crisis by not providing an infrastructure. This was most prevalent in the banking system, which crashed due to an integral weakness in the economic system. Although lots of Americans owned stock, most of the stock they owned was not paid up front with actual cash. The American people went to stockbrokers to buy stocks. The stockbrokers would lend them money that the stockbrokers themselves had borrowed from the bank. This created an unnecessary middleman in the crisis and helped to further the confusion when the system crashed.
Traders surged about brokerage offices, watching their holdings wiped out. It was one of the worst breaks in history. Minneapolis Star accounts of Black Tuesday.
Bank failures had eventually led to the stock market crisis, as it ultimately became an economy-wide catastrophe. During the roaring 1920s, the American people invested millions of dollars into stocks. In October of 1929, the stock market crashed. People tried to pull out their money, but because of the unsafe banking, the banks did not have the money that the investors put into the banks. During the 1920s, 70 national banks failed each year. After the crash, 744 banks failed in 10 months. Starting into the 1930s, farmers could deposit less and less into the rural banks. Therefore, the banks did not have enough money to function. 9,000 banks closed. People began drawing their deposits to try and regain their money before it was gone. The banks were unsure where the economy was going and stopped being so lenient to give loans.
1929. It came with a speed and ferocity that left men dazed. The bottom simply fell out of the market. The streets were crammed with a mixed crowd, agonized little speculators, sold-out traders, inquisitive individuals and tourists seeking a closer view of the national catastrophe. Where was it going to end? Account of the stock market crash in New York.
In the late 1920s, Americans were prosperous as they ultimately had to take out loans to invest in the stock market. Many people would purchase stocks on margin, which was a form of loan through a stockbroker who loaned money to people to invest in stock. If the stocks dropped, the stockbroker made a margin call, which forced the people who invested to pay back their loans. Unfortunately, people had abused the system because they had invested in huge portions of money that in reality they didn't actually have. A significant number of Americans were forced to borrow money so that they could buy stocks. In August of 1929, stockbrokers were lending money to small investors. Rising share prices had overall led and encouraged more Americans to invest. In 1929, on October 24th, Black Thursday came into effect as it was the first major downfall of the stock market crash. On Black Thursday, the market had lost 11% of its original value as soon as the first bell went off. The stock market was shut down through the weekend of October 25th through October 28th, then leading into Tuesday, October 29th, being viewed as the worst day of the stock market crash of 1929. On this day, 16 million shares had been traded, and the stocks traded on October 29th was a record that hadn't been broken in over 40 years. Throughout the day, stock prices had fallen even further.
Wall Street, often seen as the place to be for any aspiring businessman, is often viewed in the public eye as the source of all evils, which is not an unfounded fear. They had their hand in most of the problems that led to the Great Depression, being the metaphorical center for American commerce. The lack of a sturdy financial structure, the way that members of Wall Street manipulated the stock market, the way that the banks crashed, and the way that the stockbrokers contributed to the problem all were direct causes towards the beginning of the Great Depression.